welcome to accounting. We now have 2 more classes before the midterm exam. So I thought we ought to take inventory of where we are and what we expect to cover. My expectation is that we will, in today's class, let me give you the forecast. In today's class, we are going to go back and do some work on ratio analysis. The work we're going to do is we're going to go back and look at the case of the unidentified industries. So we'll spend 10 or 15 minutes on that. From there, we're going to do a little present value work and go back and use Excel. Y'all enjoyed just a little too much last time when I made a fool out of myself in Excel, so I went back and figured out what I did wrong. And much to my chagrin, it was operator error. Had nothing whatsoever to do with this crummy computer. The crummy computer worked just fine. Boiling wasn't working so well. So I figured that stuff out, and I want to show you some things I think are very, very important for you to use in Excel. From there, we're going on to Chapter 6, review Chapter 6, which is inventory. 1 or 2 little things there. Chapter 7, we'll finish that today, which is fixed assets. And we will start and probably finish most of Chapter 9. So my expectation is we will have at least started Chapter 9, and Chapter 9 is simply the equity side of the balance sheet. Now, Chapter 10 is bonds. Next class, we will do bonds. So my expectation is we will finish bonds in the next class, and we will start cash flow. However, we'll probably only just begin cash flow. So my expectation is that the exam, which for live students is going to be given on the 19th of March, which is the Monday after you come back from spring break, the exam will cover in our notes up to Chapter 10. Okay, but probably will not include Chapter 13, or Chapter 12 rather, which is cash flow. So it'll include 1 through 10 plus 13 ratios, but it will not include Chapter 12, which is present values. Now, in terms of the problem sets, what is fair game? And the answer is, by the time we are through with class next week, problem sets 1, 5, again, 5 is present values, 1 and 5 you've prepared for right now, as well as 2 and 3. Problem set 4 is primarily dedicated to cash flow analysis. So problem sets 1, 2, 3, and 5 would be the basis of old exam questions that would form, the best things to study for the exam on March 19th for the live students. Tape delay students, of course, you're taking the exam 1 week later. Any questions about that? Now, I want to open up the class today to questions about the project. So I thought we would start with that, and then and see if anyone has. I will open it up now for any questions. Some people had asked me some questions early on, and I thought we'd answer any questions about the project. So the forum is now open. Any questions about the project? Let me tell you information about the project. Let's make sure we know the dates. So project, the due date for live students is Thursday, March 8th. The due date for tape delay is Thursday, 7 days later, the 15th, Thursday the 15th. So the tape delay students is exactly 1 week later. Now, here is my request. I get a large number of emails. And so in the subject box of your email, if you would please let me know that this is FMA, Financial Manager of Accounting, Project 1, P-R-O-J, or anyway, and then put your name. And that way, when I look at, when I'm going through all the emails, I will know what you're telling me, what's going on. Because what I will do is the TAs are going to grade these projects. And since I have the most resilient. There's a lot of people who are going to be sending stuff to me. And the TAs, their email accounts will blow up if you just send it to the TA. So that it should go to me. And so where are you going to send this thing to Boylan? At rpi.edu. So you're going to send everything to me, and then I'm going to forward it to the TAs. That makes sense, everybody? That way I'll have a copy of everyone's, in case we have any problems down the road, I will have a copy of everything that was sent. And so I will act as control, and I will also act as, any kind of regrade or anything like that. But the grading will actually be done by the TAs. So just so you know, ahead of time. So if you're going to bribe somebody, bribing me is not going to do you much good for this grade. Bribe one of the TAs. It will be much more efficient use of your cash. Okay. Answered a couple questions earlier. Did you want to ask that question again?
When you pay a down payment, do you consider that as reducing the liability, or is that like an expense?
Okay, so the question is, suppose you buy property, and the question originally amounted from the mortgage, and the question now is if you make a payment up front, you have a down payment, the amount of the liability is simply the amount you borrow. So, for instance, if you were gonna take out a mortgage on a $200,000 house, and you put 10% down, $20,000, the mortgage would be $180,000. Right, does that answer your question? Okay. Now, in this project, you are required to take out a mortgage. You have to. However, the amount of the mortgage is up to you. You are required to purchase property, plant, and equipment to the tune of $2 million. You are required to purchase that much property, plant, and equipment. However, you can finance that property, plant, and equipment any way you want. You can finance it completely with debt. You can finance it partly with debt and partly with equity. You can finance it partly with debt and partly with the amount of cash you already have on hand. So you have a number of different opportunities in how to finance this particular purchase. Now, one thing you want to keep in mind is when you purchase property, plant, and equipment, each one of these three categories has a different depreciation schedule. And on the balance sheet, you must include accumulated depreciation for each of these separate categories. Now, how do we depreciate land? And the answer is we do not. Right? Land is not depreciable. So whatever you put in the land, again, just take an example. Let's say of the $2 million, you decide $300,000 goes to land. Then that $300,000 will stay constant throughout the life of the 5 years, because you will not depreciate it, you will not change it in any way unless you buy more land down the road or sell the land you have. Right? However, if you decide that, say, $1 million goes into buildings, right? Of the $2 million, $300,000 went to land, $1 million goes to buildings, then that $1 million will be depreciated over a relatively long life. And long is your judgment call. Tax rule says it has to be at least 27 years. However, many firms are depreciated over 30 or 40 years. We'll talk more about strategy in that kind of a thing later in class. Equipment, again in our example, $2 million, we have $300,000 for land, $1 million for buildings. Equipment therefore is how much? $700,000. And equipment would be depreciated over a relatively shorter lifespan, 5 to 15 years. Again, discretion on your part. So you will then need to keep track of each one of these three categories for each of the 5 years, showing the historical cost, which is, say, for the building, the $1 million, less its accumulated depreciation each year. And so the net book value of the equipment will change every year and will decrease every year because accumulated depreciation will go up, and that's the contra account. Does that make sense to everybody? And it's very important to show both the historical cost again for the building, the $1 million, and its accumulated depreciation, which of course would be bracketed, or would be a negative number, kind of. It's a contra asset account. Okay. Am I answering the questions that you had?
Sometimes I fall into this pit of trying to create too many accounts to track too many things. Like for instance, should you try to track how much of the loan you've paid off on the land, on the equipment separately, or is that just loan and that's debt and debt is debt?
If I were you, I would create one loan account, and then for the loan, you'll need to track how much interest is paid every year, and assume you take the loan out on January 1st, just makes life easier. And so you have one loan, and it doesn't matter what you used the loan for, right? Because in fact, you could take out a very small loan and still buy $2 million worth of equipment. So the liability is treated separately than the asset for the accounting purposes.
You're allowed to borrow up to $5 million, and all you need for this initial investment is $2 million.
That's
is there
right.
a hint that you should borrow more, or is that also like for account payables? Is that considered part of that $5 million cap?
Well, again, there's a kicker here, and the kicker is that the individual who maximizes stock price gets a $20 bill. So all I'm doing there is giving you more leeway to become more creative. That's all I'm doing. Now, you could borrow more, that you could borrow less than $2 million. You could borrow more than $2 million, which is the option firms almost always have, right? They can borrow more than they need right now, or they can use current cash and borrow less than the project right now. And that's always what's available to firms. And the question is, how much debt and how much equity will help you maximize stock price? That really is what it comes down to in this project. Now, let me tell you a little bit about the grading. I'm going to grade you in this project only on how well you do the accounting. If you do a miserable job of winning the $20, you can still get an A in the project, right? You can make miserable financial decisions in terms of maximizing shareholder value and still be a great accountant. So you're getting graded in this thing based on your accounting, not on your financial savvy. The $20 goes to financial savvy. And the winner in life is the person who wins the $20. I hope that's clear to everybody, right? I mean, the reason I do this is because this is an accounting class, and you have to understand the basics of accounting. But applying accounting to decision making, which is the winning the $20 part, is by far the most important part of this class. Is using accounting information to try to figure out how it affects value. In this case, the value is $20 in your pocket. But in reality, the value is how the accounting affects shareholder value, how it affects stock price, things like that. And it turns out that the model you're using, which is to use earnings per share, and then that determines stock price, is a model that's extremely prevalent in the market. It's a model that, in fact, has power at every investment banking firm in America. They use, now, the model you're using is trivially simple, but the model they use also involves forecasting earnings per share, because earnings per share have an effect on price. So, however trivial this particular example is, it gets you thinking about how accounting affects earnings per share. Now, your question here about the amount to borrow is a good one, right? So the issue you need to be thinking about if you want to win $20 is, should I borrow more or should I borrow less? Let me put that question differently. Remember we talked about the amount of debt and the amount of equity a firm has, the amount of leverage a firm has? And there's some optimal amount of leverage? Well, that's the issue, right? How much leverage should this firm have? And what you can do is you can design your spreadsheets, then you can change the amount of debt and find out which one affects earnings per share, which therefore affects price. So you can either think through it logically, or you can design the model and just plug numbers iteratively until you figure out what the best combination is. In any case, you're gaining intuition about how firms maximize shareholder value. Does that make sense? Now, there are lots of other issues here in terms of maximizing value, I mean, the assumptions that you make, whether you use LIFO, FIFO, or weighted average to calculate inventory, that affects earnings per share, which then in turn affects stock price. Right? So you get to choose LIFO, FIFO, weighted average. You get to choose what depreciation method. Now you probably want to use straight line, right? You get to choose the length of time over which you depreciate these assets. The length of time affects the earnings per share, which affects stockholder price. Is this stuff starting to make sense? Okay, and I will go through a little bit more about what I expect you to actually hand in terms of the project when I open up Excel and we start talking a little bit about letting Bob crawl the hole that he dug last Monday. Any other questions about the project? Yes.
When you talk about all the financial ratios that you want us to calculate,
the ones in the notes.
Okay, all the ones in the notes plus that one that you just
plus the debt ratio.
Okay.
Right.
Thank you.
Certainly. And I want you to give a short description of how well the firm is doing, right?
Oh, for each.
Not for each ratio, just overall. Is the firm doing well? Would you buy the stock of this firm? Really is the question I want you to answer. Based on a financial analysis, based on the ratios. Okay? And why? Now, everyone's analysis is going to be peculiar to your own assumptions, right? Depending upon your assumptions, depending on what assumptions you make, that's going to affect stockholder value. So your assumptions are going to affect how well the firm does, which is typical. Again, this is part of what every firm goes through. They have to decide LIFO, FIFO, weighted average. They have to decide depreciation lives. They have to decide all kinds of different things from an accounting context.
Talk about stock and whatever. We haven't done that yet. That's the equity portion.
The equity portion, we'll do more about that today. That's Chapter 9, which we should get to at least enough so you can do the project. So as far as I'm concerned, by the end of class today, you will have everything you need to do the project. And for the most part, you already have enough to do the project, with the one exception of we haven't talked about equity enough to really understand that. And we'll do that today. But that's fairly simple, fairly straightforward, in my opinion. Another question.
Are the marketable securities considered cash on hand?
Are the marketable securities considered cash on hand? The marketable securities, I mean, it depends upon.
We can use those towards
Yes. Oh, could you sell the securities to buy equipment? Is your question? Yes, you could. Okay. You certainly could. Yes. If that's what you mean, yes. Right. But you want to be careful and make sure you know what rate of return you're earning after tax on the securities before you. Again, your trade-off is, do I take out a loan at some percent and give up or not, right? And that becomes a financial decision that you have to make. You have to make a decision, too, do I invest in tax-free securities or do I invest in taxable securities? And so the issue then becomes, what's the after-tax rate of return I'm going to collect on these securities, right? Again, just like every firm has to think about, they have to think about cash flow after taxes or net income after taxes. And so that's what you have to do, too, in order to make reasonable decisions.
Is there a downside to issuing common stock?
There certainly is.
It's not apparent to me right now.
Well, what's the downside of issuing common stock?
Higher number of shares.
A higher number of shares. Look at your earnings per share calculation. Earnings per share is going to be what? Net income divided by number of shares. Now, if you sell more common stock, what happens? Number of shares goes up. What happens to earnings per share? It goes down. Is that clear to everybody? However, this is if you sell stock, right? However, if you sell bonds, what happens? If you sell bonds, what happens?
Net income goes up.
Net income what?
Net income increases.
Why would net income increase? You meant decrease.
Yes.
Right.
Because you got
You pay out interest, right? So if this is bonds, then net income goes down. Why? Because of interest expense, right? The interest expense goes up, net income goes down. The earnings per share go down. So no matter how you finance, there's a negative impact on earnings per share, whether you finance through equity or you finance through debt. However, the question is, right, which one of these two options gives you the higher earnings per share? You take a hit either way, but one way is better than the other, right? Because either way, earnings per share is going to go down, at least to some degree, right? And so the question is, do you use debt or do you use equity to finance that thing? And that's what you have to figure out. That's the whole point of the $20 bill in this project. Bill.
What if you sell warrants?
You can't sell warrants. Okay? Because if you sell warrants, you have to figure out how it affects earnings per share. Because warrants affect earnings per share. And you have to do that on your own. Because I'm not going to tell you. Because it's tricky. I know how to do it. I do it at firms, but it turns out to be a tricky calculation. And I'd rather you kept it simple, at least in terms of the equity structure. I mean, you could sell preferred stock as well. Can't do that in this project. It just complicates life.
Okay.
Okay. But good thinking. Okay. Any other questions? Okay, so much for the project. We'll come back to the project a little bit when we open up Excel. Let's do a little bit of work in fixed assets and present values. Here's the situation. Suppose your great-great-great-great-grandmother was the person who bought Manhattan Island from the Indians. What did she pay for that? Okay, American folklore is that we bought Manhattan Island for $24. When did we buy it? Again, American folklore, pure myth, right, in my opinion, a lot like religion, right, pure myth. 1624 is when we purchased Manhattan Island. Now here's my question. Suppose instead of buying Manhattan Island for $24, your great-great-great-great-granny invested that money at 5%. How much would you have right now in the year 2001? How much would you have right now? So what we're looking at is 2001 less 1624. 377 years, give or take. Does that make sense? Now, so what we're looking at is the future value of $24 over 377 periods at 5%. And when I did that calculation, I got about $2.3 billion. So the question is, would you rather have Manhattan Island or $2.3 billion? Manhattan Island, okay. Now, what rate of return could you have earned over that period, do you think? Well, suppose it's 10%. If it's 10%, now is the value you have now going to double? And the answer is no, not at all. Right? It's an exponential function. It's going to increase by a lot more than double. Now, someone checked me. When I did this, I got 9.6 times 10 to the 16. Now, that's a big number, right? Could you have gotten a 10% rate of return over 377 years? And the answer probably is yes. Suppose 15% is the number. Then you get 1.8 times 10 to the 24. Now, I could live on that for 3 or 4 weeks, you know, and not be the least bit wanting. Now, what's the moral to the story? Where's the NASDAQ right now? As low as it's been in 2 years. When is a great time to start investing?
A year ago.
No, I'd say right now.
Compared to this now, 2 years ago.
Yeah. 2 years ago, you'd be SOL, right? So the present value nature of the rate of return, right, says if you're gonna start investing, those IRAs we talked about in class, now is a great time to start thinking about putting $2,000 away for the year 2000, $2,000 away for the year 2001, and get that money working for you. Because the sooner you get it working for you, the sooner it turns into billions of dollars. Because the present value nature of what's going on, most people in this room are pretty young. 40 years from now, that $2,000 can turn into a lot of money if you invest now. Questions? All right. Next thing, the case of the unidentified industry. If you come to the computer screen, please. So in Chapter 13, we have 5 sets of financial statements. Financial ratios. And we have 5 different industries. And your job is to choose which industry lines up with which of these sets of information. Now, I thought we'd be very careful. Electric utility, right? Number 1 right here. Pretty much you know what an electric utility is, right? Japanese trading company. By a Japanese trading company, that's meant a company that buys and sells goods. Basically, they would be shipping it and selling it to, one of the big chains in America.
Like a wholesaler?
Like a wholesaler. They're a wholesaler, that's right. And they're essentially a middleman. They buy stuff in Japan and they ship it to America and dump it off at wherever. Retail jewelry chain. Okay, this is the chain of people, not the jewelry manufacturer, but the place in the mall, like K Jewelers, things like that. Automotive manufacturer, that's Ford, but that's the manufacturer. It's not. Again, in order to understand the inventory, you have to understand the automotive manufacturer is not the place where you go to buy the car, right? That's the dealership, which is a separate organization. This is Ford or GM, the manufacturer. And lastly, the supermarket chain is, you know what that is. Okay. Who wants to go first? And tell me, and choose which, so you can come off the screen. So, again, I have the sheet in front of me. Who wants to take a risk? Now, of course, I asked everyone to be prepared for this. So everyone's jumping up and down saying, call on me, Bob. I know the answer. I'll start with one. Go right ahead.
I think B might be the automobile manufacturer.
Okay, B is your automotive manufacturer. Why?
Because it has pretty high property and equipment percent, and I assume that would be the most, machine intensive, plant intensive kind of business.
Well, it's certainly one of the more plant intensive businesses. Let's go down and look at a few more ratios. Notice, let's go down to the profitability ratios. Notice net profits divided by net sales is 16%. It is the highest rate of return 3 times over, or even 4 times over, versus any other one of these industries. Does that agree with your theory on what this is?
That means they really need to sell that car in order to get profit.
No, that means that their profits average 16% of sales, right? Does an automotive company have a profit margin of 16% of sales?
This is different than indicates the percentage of each sales dollar not absorbed by cost of goods.
No, net profits divided by net sales is simply net income divided by sales. That's all that is. Right? It's their profit margin on sales. That's all that is. So you need to think about which one of these 5 industries is going to give you a relatively higher profit margin on sales.
I thought B was the jewelry company.
Okay, B is the jewelry company.
Because of the profits to sales. Because jewelry is marked up 400% or more, typically, especially in a retail chain. So I chose that one to be the jewelry chain.
Okay, now look at how about if we look at B? What about how much inventory does a retail jewelry?
Why?
Okay, and why would why would K Jewelers have a huge amount of property, plant, and equipment? You picked B, right?
Yeah. Oh, you said they're not manufacturing, sorry.
Right. This is K. This is not the manufacturer, but the retail. This is the K Jeweler, the mall store. That.
I'd say the electric utility because they're going to have a lot of equipment. They're going to make a lot of money off of it. And
no, is which one?
Is B. Is B.
Is B. Okay. Just want to make sure.
All right.
I agree. Okay, so let's see. Defend that. Why would the electric utility have a small amount of receivables? So it's 5.4%, which is relatively small, relative to the other. Why do they have a small amount of receivables?
Because people pretty much pay.
Okay, they pretty much pay quickly.
Yeah.
Right?
You're not going to spread it out over a long period of
The
time.
inventory is very low. Why would inventory be low?
They make it in that it goes out the door.
And how do you inventory electricity? Right? You can actually do that, right? I mean, to some extent, but it's hard to do. It's called batteries, right? But it's not a high percent of sales. So PP&E is huge. You hydroelectric, or you have a nuclear plant, or you have something that manufactures this stuff. Okay, so it makes sense. How about your liability structure? You have long-term debt, 29%, fairly high. Why would that be so high?
Buying all the equipment. I don't know.
Well, again, if you look at long-term debt, it's relatively higher than virtually any other.
Long-term debt over what? The equity?
Well, relative to total assets, it's almost 30%, right? Why would long-term debt be so high?
Because of things like the California energy crisis, where
they're going to be around for a while.
Okay.
You have longer-term.
Let's ask that same question a different way. Let's go down to selected ratios below. Why would their profit margin be 16% of sales? Why is their profit margin so much higher than any other industry we're talking about here?
Because there's no competition.
Because there's no competition, right? How do firms set the price? They're regulated. And so the government basically, historically speaking anyway, not in this new age of deregulation, but historically speaking, the government regulated the industry and it basically mandated a relatively high rate of return. In this case, 16%. Okay, so B then is electric utility. I'll go with that.
Maybe A is the automobile one.
Okay, so suggestion is that A is the automotive manufacturer. Okay, now I go down and I see cash is fairly high. Think about that for a second. Receivables are fairly high, 22% compared to the other industries. Why would receivables be so high for an automotive manufacturer?
Loans and leases.
Who do they sell to?
Dealers.
Who does Ford sell to? Ford dealers, right? What are the payment terms, generally? They're usually very liberal, right? The deal is you pay us when you sell the car. Or you have 60, 90, 120 days often to make the payment. Hence, the automotive manufacturer is going to have a relatively large amount of receivables, but those receivables are to its own affiliates, right, the Ford dealers, in which they have some equity stake. Ouch. I don't know what that was. Okay, so that makes some sense. So we go down, let's see, net profit to sales, 4%. Is that reasonable for automotive manufacturer? Yeah, that's okay. Profit relative to owner's equity, 12%. A little low, but okay. Collection period, 71 days. Again, that makes sense because receivables are so high, right? Inventory turn is relatively high. Why would inventory turn be so high? Why is inventory turn so high?
They manufacture as much as they are going to sell.
What's in inventory for an automotive manufacturer?
That year?
Any year.
The cars and the raw material.
Are there any cars in inventory?
No.
Right? Inventory for these people are wheels, motors, metal. Right? As soon as the car gets produced, what happens? It goes on a truck and gets shipped to the dealer. Right? So the automotive manufacturer does not hold cars in inventory. Every car is already spoken for. As it comes off the line, it goes on a truck and goes out the door. So inventory is relatively small because it only includes raw materials. Excuse me. Questions? Does that make sense? Now the reason I think this is so important and the reason I'm spending so much time on this particular example is because the important thing about accounting is to make sure that you're using accounting and it agrees with your business intuition. I mean, the whole point of doing accounting is to be able to understand what companies are doing. It gives you information about companies. And so you need to think about the company in the context of its markets, the context of its business practices, right? And so what this particular case does is it forces you to think about 5 different types of firms and how their accounting would differ. And that to me is a very, very powerful understanding of what accounting is all about. Because you need to understand what the business is doing to understand anything about the accounting, at least in as far as making decisions. Because the accounting doesn't make decisions. It's the business practices, but the accounting measures the business practice. It measures what's going on in the markets. Does that make sense? Okay. So, is A the automotive manufacturer? Answer is yes. So A, auto. And so we've limited it down some. So what do we have left? We have a Japanese trading company, a retail jewelry chain, and a supermarket chain. Now, what would be the thing that would best signify, say, a supermarket chain? High turnover. High turnover of what? I mean, we have receivables turn, inventory turn. Inventory turn. So we look at inventory turn. And we see D has 23. That's pretty high.
But the collection period is very high as well.
But the collection period is high. Right? Credit cards is instant cash to the company, just about. Okay, so what else about a supermarket chain which should stand out in the ratios?
Oh, cash has to be high percentage.
You got a fair amount of inventories as well.
You should have a reasonable amount of inventory, and well, this is a cash business, right? For the most part, most people pay either in checks or in cash. I mean, I'd guess 90%, 95% is in cash at a grocery store. Would you expect them to have a high amount of cash? Sure. Would you expect them to have a high amount of inventory relative to many firms?
Collection period is going to be short.
Sure. Collection period should be relatively short because everything comes in cash. Okay, which is it? C.
Why not E?
Why not E?
I said it's either one of them is going to be retail jewelry and the other one's going to be markets, and I can't.
How about profitability? Which is going to have a relatively higher profit margin? Retail jewelry or
Jewelry.
Supermarkets survive on incredibly low margins. Right? In this case, return on sales right around 1%. Okay, C then is supermarket.
Now, what's the significance of net sales over total assets being so high?
let's see, sales over total assets. Why would that be so high? It's a good question. Why for a grocery store would sales over total assets be so high?
Volume. Such a large number of sales.
One is the amount of volume,
Low assets.
and the other is low assets.
Shelves.
Because most department stores lease the space, and therefore don't have the asset of building on their balance sheet. Their primary assets are the inventory and receivables and cash. Does that make sense? Good question, though.
So what makes up the property, plant, and equipment being up?
Refrigerators and stuff?
Well, they could own some, right?
Delivery truck.
Cash registers.
They could own some, but it could be. I mean, they could own the buildings. They could not. Often it's leased, but it turns out that when you lease something for a long term, you often show it as an asset. That's called capitalizing the lease. So even though they lease it, it actually shows up as an asset on their books, or it can anyway. So anyway, okay. So we have D and E left. Was what?
Japanese trading companies, D.
Japanese trading company is D. Why, Phil? Why not, he says.
I thought the receivables would be very high.
Okay, why would receivables be high?
Well, I figured if you're dealing with such volume, you may be booking for a lot. It could be a futures contract. It could be various other things that you're doing as a trading company. And I figured, well, you may not have to pay up front. You may have a couple of months of flexibility.
Okay. Well, but I have a question for you.
Sure.
You go down to total liabilities divided by total assets for that particular ratio.
Yep.
96%. So the debt ratio is 96%. So 96% of the assets are financed through debt, 4% through equity. How can that be? How does that make any sense at all?
They don't have any assets.
Well, no. That doesn't make sense because, however, not of assets in this case. It's simply a question of what percent of the assets were financed by debt, right? So the issue is not do they or do they not have assets. The issue is how do they finance the assets.
A warehouse and the inventory. So that's your total, and most of it is inventory that's being sold.
Okay, if it were an American trading company, could an American trading company finance 96% of their assets with debt?
No.
And the answer is no. So Bill, does that you understand my question now?
Yep. Mm-hmm.
Why is it that a Japanese trading company can finance 96% of their assets with debt, or an American company couldn't do that in a million years?
Because the government subsidizes.
Government subsidizing is a good guess, turns out to not be. I mean, yeah, that's certainly reasonable. That would account for it. But it turns out that's probably not why or what's going on in this case. So we need to know a little bit about how Japan does business to figure this one out.
Don't they have like relationships with banks?
They have relationships with, what are those relationships called?
I forget. I remember you taught that last semester, but
Yeah, boy, you said boil in the past.
Something like GE Capital Financing and other GE businesses.
Yeah, could be like that.
Cartel.
Ah, I just heard the word. Go ahead. Who said that? Who are you?
Brad.
Okay, Brad. Koretsu is right. Well, but the word is koretsu. Now, what's at the heart of a koretsu?
bank.
Brad. You with us, Brad?
Yeah, I'm here.
Okay, what's at the heart of a koretsu?
Bank.
A bank. That's exactly right. So we have a bank at the heart. And what happens in Japan is it's an affiliation of many different companies, but at the heart is a bank. And the bank owns stock in each one of the affiliated companies. And the affiliated companies, in turn, own stock in each other. Now, why doesn't this happen in America?
Because it's illegal.
Because banks are not allowed to own the common stock of companies in general. I mean, those laws are changing now. But they haven't changed enough so that there would be karetsus in America. Now, in Korea, they're called what? They're called chaebols. In Europe, multinationals. So, a karetsu, right, since the bank has ownership in the Japanese trading company, the bank is willing to lend money to the trading company because the bank owns stock in the Japanese trading company. And therefore, the Japanese trading company is able to borrow more than perhaps they should, or at least by American standards. Conversely, the Japanese trading company has sources for much of what it purchases with other members in the karetsu. Does that make sense, everybody? Now, as someone alluded, even though we can't have banks at the heart of a karetsu in America, we could have something like what? GE Capital. What is GE Capital? GE Capital, for all intents and purposes, is a bank. It just has skirted the rules for it doesn't get called a bank. GE Capital then does what? Finances many different businesses within GE. Does that look like a karetsu to you? Looks like one to me, at least to some extent. And a very profitable one, I might add. Right? So, I mean, what's going on is when you base your operations around a bank-like entity, something that can finance various businesses, it turns out to be a way so the individual businesses can lower their cost of capital by incurring relatively higher amounts of debt. Does that make sense to everybody? And as long as the bank is making money, everybody's making money. At least from a financing perspective. Does that make sense? So what's left? So we have what D then was the trading company. So we go back here. And therefore E is what? Jewelry. Questions about that?
Why is the collection period on the jewelry so long? I guess it's not terribly high, but it's 23 days. If you purchase jewelry, don't you usually have to pay for it up front?
Let's see. Collection period, 23 days. 23 days is relatively short. I don't know if you've ever been to one of these places, but they will allow almost anyone to buy stuff, and they either use their own credit terms, they sell their own credit card-ish kind of thing, and I would suspect it's something similar to an installment sale kind of issue. That many people walk in and they take cash, but those who don't have cash and still want to buy something, these stores bend over backwards to collect 21% per year financing the jewelry.
I'm sure they do.
Yes.
Okay.
And I suspect that's what's going on there. Any questions? Enough ratio analysis. Okay. So what I thought we'd do next is let's go back to the situation, the Excel stuff we were talking about last time. So I am simply going back to the same example we were doing last time, more or less. And the basic information last time was a net present value example where we had the cost of this particular item was 400 million, 400,000, some whatever. Number of years, asset life 4, Earnings before depreciation and taxes, 200. Tax rate was 40%. Interest rate, I now have on the docket as 12%. Then what we did was we went through and developed our present value model. And our model looks like so. Let's make this 150. Can everyone see that? Our model, we have the basic information up top. Again, we already did this in class, so this is a quick review. Now, one of the most important aspects of the financial accounting class, and in fact, what I tell students at the end of the class is, there's two things I want you to understand when you leave my accounting class that we did in financial accounting. And the two things are understanding cash flow, and the second thing is present values. And this is an example of why those two things are so important. Because what we're doing here is doing a net present value, but the net present value is based on cash flow, not on net income. So what we have here is a situation where anytime we do a financial analysis, we calculate the internal rate of return and the net present value, and those numbers are based on the cash flow. And the cash flow is we have to understand how to come down to net income, to which we add back depreciation and get cash flow. Questions about that? Now, what I'm going to do is, again, this is what we did last time. Again, nothing new, so I'm going to take that, and what I'm going to do is I'm going to duplicate this particular sheet. And now, so I've duplicated PV, I don't know if you can see, this says PV model down below. I now have PV model 2. And what I'm going to do is I'm going to augment that model a little bit up here. Now, what I'm going to do is I'm going to go to the View menu, go down to Toolbars like I did last time. But here's what happened last time and why Bob got so confused. If we go down to the Control Toolbox, which I did last time, which I shouldn't have, and I'll bring it up again, that gives us all kinds of things, including our spinner button. Well, it turns out that's not the, I didn't realize the spinner button would come up on two different toolboxes, right? Or two different toolbars. So if I don't go there, I get out of there, I go back to View, go down the toolbars, and I go to the Forms toolbar. Here again, I have a spinner button. And so I'm going to click that spinner button right there. And then I'm going to come up here, and I want to be able to manipulate the cost of the asset. So I'm going to put a spinner in right there. And notice how I have this huge spinner thing, right? Now I'm going to take that huge spinner thing, I'm going to make it much smaller and easier to deal with. Make it smaller, then I'm going to take it and put it right here. In the same cell right here?
In C3. Could it be in C3?
You could put it in C3, but then you wouldn't see how you were changing things. Because you want to be able to see how you're changing things. Right.
Gotcha.
Now if I go back to the spinner and I right-click on the spinner, and I come down to Format Control, this is one of my favorite things about this particular function. And that is the Format Control comes up so you can't possibly see what you're working on. And no matter where you put this thing, it happens that way. It has this uncanny sense. So I'm going to move it down here a little bit so I can see what I'm working on. And the current value of this thing is the value, I'm going to link it to this particular cell, which is C3, the cost of the thing. So the current value is 400. Minimum value is 0. I'll let that alone. The range on a spinner is 30,000 units. Incremental change, I'm going to change the incremental change from 1 to, say, 10, which would be 10,000 or 10 million or whatever the 400 units represent. Now the cell link, and this is the thing that I was looking for last time, I'm going to link it to this particular cell right here, cell C3. Questions about that? Now, if I go back to this spinner right here, and I'm going to move it down just a little bit here. So if I go to this spinner and I click the F button, I get 410 because I incremented it by 10 units, right? And when I change my cost, notice that all my cash flows change, and below that my net present value changes. So here what I do is I simply click this thing and I go up, and as I increase the cost, things change. Does that make sense to everybody? Okay. Now, what I can do then, if I go back to this button right here, I can then copy that thing. And what I'm going to do, I'm going to copy the same size. So if I want to copy it and put it about right here, I'm going to hit Control V or just paste, and now I have another spinner of the same size that I used previously. So I don't have to go back and resize it every time, and I have a certain consistency to the look of my spinners. Does that make sense? I then right-click on this spinner because I want to link it to something, so I am going to format it. And you always have to move it. Thank you, Bill Gates. And I'm going to link it to C4. So the current value of C4, so I'll change this cell right here. The current value is 200. Minimum value could be 0. The range is 30,000. Incremental change, leave it at 10. This is as good a number as any. And you can make it 5 or 1 or 2 or whatever you want. It depends upon how you wanted to change things. And now we go to cell link. And I'm going to link it to cell C5 instead. And then I'm going to hit OK. Oh, that's just wonderful. So I go back here, and now I do this, and notice my EBDT changes in my model. And with it, right, as I go up here, my net present value goes up each time I do this. Does that make sense to everybody? Any questions about that? Okay, let's say I want to change the interest rate. Things are a little bit more complicated when we change the interest rate. Because if I go here and I go to link this thing, so I'm going to paste it in right there. So now I have a new spinner, I want to link it to the interest rate. The problem here is that the spinner does not like percentages. It likes nice whole numbers. So what I'm going to do is I'm going to come up here in column B. I'm going to create a new column, right, by Control Shift plus. Create a new column. I'll make that fairly small. And I'm going to change where my 12% comes from. Instead of having 12%, I'm going to make it 12 divided by 100 gives me this 12%. So here I'm going to say this equals 12 divided by 100. Click. Right? Now what I need to do is when I link this, I come up here and I set my format control. What am I going to link this to?
B3.
I'm going to link it to B3. Right? So I'm going to link this thing to B3. I'm going to make the incremental change 1. Current value is 12. Now, so what should happen here is as I increase this, B goes to 13, and therefore D7 goes to 13. Now let's make sure we know what happens to the present value. So notice what happens to the present value. Now, as the interest rate goes up, what happens to the present values? Let me say that again. As the interest rate goes up, what happens to the present value? Well, let's see. If we go, notice what the present value is right down here. And I remind you that the net present value number that Excel will give you, if you just use net present value, is wrong. However, the correct number is over here, which, again, we showed that last time. So I want to remind you of that. But now, if we go up and we increase the interest rate, notice the net present value, the higher the interest rate, the lower the net present value. Why is that? Why is that?
You're changing your target percentage for your internal rate of return.
It turns out that's one of the most important things to understand about present values, is the link between the present value and the rate of return. Does that make sense? So the example we just did, right, allows you to vary these things, but before we leave this particular example, we need to talk about the link between the rate of return and the present value. Or another way to say that is the rate of return and the price of the project. Because the price of any asset is simply the present value of the future cash flows at the required rate of return. Now, let's go back to the example that we're talking about here. Why is this example so powerful? Anybody who has ever done any kind of financial analysis has taken their financial analysis to their boss and said, look at the wonderful work that I have done. And what does your boss say?
What does it mean?
Well, what if the cost went up by 10? Or what if the cost went down by 12? Or what if? Now, if you design your model the way I just showed you how to do it, what do you say to your boss? I'm glad you asked that question, because I can answer any question you have very easily. You want this to be 12, 14, 18, 25%? It doesn't matter. It doesn't matter. Because if you design the model correctly, you can do sensitivity analysis. What these spinner buttons allow you to do is to do sensitivity analysis and to really go back and analyze anything that's going on. And look at the high bound, the low bound. It's an incredibly powerful tool for doing sensitivity analysis and being able to communicate with managers. Questions? Any questions about the spinner stuff or the model we just developed? So we still need to, I'm going to come out, I'm going to take Excel off. We still need to figure out what's this relationship between price and present values. So price and present value. Next on our topic. There once was an asset that was sold. It was actually a bond that was sold by the English government. And the bond was called a console. Now the console had a picture like this. The government would collect a certain amount of money when they sold this bond, and they'd agree to make payments forever. So the government would get the money up front, and then they'd make a certain amount of payments, and it was the same payment every period, which we would call an annuity, right? Now, here's the question. How do you figure out the price? This is the price right here. How do you figure out the price of the bond based on the annuity? And the answer is, well, the price, right, P, was simply equal to the present value of the annuity, whatever that number is, at whatever the market rate of interest is, for an infinite number of periods. Because this was a kind of a thing where you willed it to your children, they willed it to their children, and it went on forever. Well, it turns out, using a Taylor expansion, and all you engineers know a lot more about this than a lowly accountant would, right? If you do a Taylor expansion on an infinite series, it breaks down to this. Price is equal to the annuity divided by the interest rate. So let's put some numbers into this thing, make it come to life. Let's say the annuity is $100. Let's say the interest rate in the market is 10%. What's the price of this particular bond in the market? $1,000. Does that make sense to everybody? Any questions so far? Now, so what that means is what? That if you're an investor and you require a 10% rate of return, the annuity is going to be the same forever, right? The annuity is constant, it stays forever, so there's going to be a relationship between the interest rate and the price. And the key thing, right, the key thing to understand about this relationship is that the payment has to remain constant forever. Now, suppose the interest rate in the market, right, suppose you, the investor, now require a 20% rate of return. Now think intuitively. If the cash payment is going to be $100 forever, but you require a higher rate of return, are you going to pay more or less for that bond? The less you pay for that bond, the higher your rate of return will be, right? The less you pay for that bond, the better off you will be, clearly. How do we measure better off? By the rate of return, or what we sometimes call the yield to maturity, the rate of return on the asset. So in this case, if the interest rate in the market goes to 20% from 10%, what happens to the price of the bond? It goes down to $500. Notice that as the interest rate went up, the price of the bond went down. In this case, the bond is an asset to the investor in the market, just like that piece of equipment that we just analyzed was an asset to the investor in the market. And notice that as the investor's rate of return increased, what happened to the present value? Present value went down in both cases. Does that make sense? Now that is the essence of a finance class, right? In a finance class, it's based on present values, and one of the key things to remember is the relationship between the price or present value and the rate of return in the market. And that relationship is inverse. And it's only inverse for one reason. And that reason is why? Because the cash flow remains constant. It doesn't change. If the cash flow changes, then you cannot predict what's going to happen to interest rate. There's not a regular relationship. But if we hold that cash flow constant, then we have a direct relationship between the rate of return in the market and the present value or price. Questions? Okay. Did I hear a question? Okay. We have about another 10 minutes or so, and someone before class asked me to do one of the questions from the problem set. So if you would get that stuff out. What problem was it? Problem set 1. T17. So what I thought I would do is I'd spend a minute or two just showing you a little bit about problem set 1, T17. Now, if you've looked at old exams, have you seen this problem on old exams? Everyone. Yeah, okay, just making sure. Get the incentive structure aligned right here. I never remember giving a midterm exam and not having this question on it, in one way, shape, form, or another. All right, what's the information? First of all, what numbers? T17. The information is what?
Sales is 160, expense is 110, net income is 50.
Okay.
A net income is 50.
I can calculate that from the sales and expense. That's okay. I don't need that.
Accounts receivable beginning 18,000 and is 60.
End at 60?
Right. Payables is 18 at the beginning and the end is 3.
Okay.
Calculate accrual basis and then the next one is calculate cash, 17A.
Okay, so this is sales. So in 17, this is sales in cash, right? Because you're going to convert from the cash basis to the accrual basis in 17. Is that correct?
Mm-hmm.
Okay, so this is sales in cash. This is expenses paid out in cash. And the accounts receivable is the... Now, if a firm were truly using the cash basis, they wouldn't have any accounts receivable, and they wouldn't have any accounts payable, right? Why is that? Because they recognize a sale when the cash comes in, they recognize an expense when the cash goes out. So I have to give you these kind of made-up numbers to be able to for you to be able to go between the cash basis and the accrual basis. Does that make sense? Now, the way to do this particular question is to think about accounts receivable and accounts payable. God bless you. So, accounts receivable, the beginning balance, again, an asset account, the beginning balance is 18, ending balance is 60. Accounts payable, a liability account, beginning balance is 18, ending balance is 3. Now, if this were a cash basis company, then sales were in cash, therefore the amount of cash that would have come in was $160,000, or $160. Right? Now, how would that cash coming in affect our accounts receivable? Does that question make sense to everybody? So when they get the cash, what do they credit? Accounts receivable. So the 160, if this firm were on a credit on an accrual basis, the 160 when the cash came in would be a decrease to accounts receivable. Now the next question is, what would sales be? And sales would then be, when they recorded a sale, what would the entry be? Increase accounts receivable, and increase an equity account called what? Sales. So, the debit to accounts receivable, right here, would be the sales that would have accrued if the company were on an accrual basis. Is this making sense? And so, if I then solve this would be 320, this would be 202? Yeah, is that right? I go over here and I have sales. $202, which I just calculated right here. Questions about that? Now similarly, with accounts payable, the 110 would be cash going out the door. How does that affect accounts payable? Well, if the credit is to cash, the debit is to accounts payable. So in this case, 110 would be a debit to accounts payable, and I then solve for the credit to accounts payable. Now the credit to accounts payable would be what? The debit would be to the expense account, and the credit would be to accounts payable, the liability account. So this thing here would represent the amount of expenses that would happen on an accrual basis. And that would be, let's see, 113 minus 18, is this 95? Please check the notes. We have the answers, right?
Yeah.
Is that correct? It's very easy to make adding mistakes in front of classes. I never make them anywhere else in my life, but in front of the class, I make them regularly. Okay, so then expenses would then be 95, and that would give me net income of 107 on an accrual basis. Does that help? Do I need to do the other one, or is this make it clear?
No, this actually was 17 was on our total.
Okay, does this now make sense?
Yes, thank you.
And going from the accrual basis to the cash basis is a little more straightforward because the T accounts make more sense in that case. Any other questions about this? Okay. let's take a quick break. It's 7:50 right now, so we'll try to get started again right at 8 o'clock. So, see you in 10.